Good afternoon, everybody, and welcome to today's webinar on optimizing after-tax incomes with private placement investment vehicles. I'm Mark Salters, Executive Director from the CFA Society Minnesota, and we thank Rick Roche from Little Harbor Advisors and David Reynolds from Spearhead for helping us take a deep dive into something that is probably not familiar to most of the folks in the investment world, and certainly not for traditional equity investment portfolio managers. So we really appreciate having both of them with us today and looking forward to what they have to say. Before we let them get started, though, we've got a couple of other thank yous to do. Megan, please move to the next slide so that we can thank all of our annual sponsors today. All the firms you see on the screen here, RBC, Disciplined Growth Investors, Nuveen, Securian, all of these folks every year make it possible for us to do things like this. They invest their assets in thought leadership, as well as some of their financial assets, so that we can provide high quality professional learning opportunities like this. So thank you to all of our annual sponsors, and especially if you're on the webinar today, double thanks. So one more thank you. Megan, move to the next slide. We also need to thank CFA Institute. Back when the pandemic was first coming on in the spring, the folks at CFA Institute reached out to our society and societies around the world asking if we would like to have a Zoom license in order to continue to deliver professional learning like this, but do it virtually. We said, thank you very much. Yes, please. And so we always want to thank them for providing this platform for us to do what we need to do. Back to the title slide, Megan, for just a second. Thank you. Only other thing to cover right now, quick housekeeping item. We're going to use the chat feature in Zoom meetings for handling Q&A. So when you are ready, as the spirit moves you, please type your question in the chat window, and Rick and David will work on those and answer those questions as time permits and as the webinar progresses. So with that, I think it's time for me to quit talking, turn it over to Rick to get us started and take us into the world of private placement. Rick, take it away.
And hopefully everyone can see the screen. Yes. Let me just first and foremost, let me thank the CFA Society of Minnesota for allowing us the opportunity to address you today. By way of an intro, I'm a 39-year industry veteran. I'm the former national sales manager at Fortis Financial. That was out in Woodbury, Minnesota. My wife and I raised our two now grown sons living in Linden Hills for 22 years. And I was formerly an associate member of the CFA Society of Minnesota. I'm a CAIA, not a CFA charter holder, but I was an associate member, and it was terrific to have that opportunity. You've already seen my, I've already told you my background. That's some of the particulars. I'm going to do a joint presentation today with my friend David Reynolds. Dave is with Spearhead Capital, LLC. The way we're going to run the program today is I'll speak for 12, 13 minutes thereabouts, hand the baton to Dave. Dave will go on for another dozen, 13, 14 minutes, hand the baton back to me. I'll do one more leg for a 12 or 13 minute time frame, and then hand the baton back to Dave, and then handle any of the questions that you have throughout this program on private placement life insurance and private placement variable annuity. So without any further ado, here's a quick agenda of what we'd like to get through today. I'm going to speak first and foremost about the fiduciary model. Certified financial planners, again, you're CFA holders, and not all CFA holders necessarily hold themselves to the fiduciary standard in all their interactions with either institutional or retail clients. Certified financial planners are required to do that as a result of a change in their ethics code that went into effect last October, October 1st of 2019. So we'll talk a little bit about that fiduciary model. Then I'll hand that baton to Dave. He'll talk about the features and benefits of PPLI, PPVA. We'll come back. We'll talk a little bit about a fair and balanced approach in terms of due diligence that you all should do in terms of when you present or consider presenting PPLI, PPVA to prospects and clients. I'll talk a little bit about how to beat the performance drag, and then I'm going to hand the baton back to Dave. So that's the program outline for today. The fiduciary standard is really 80 years old and counting. And when I say that, the legislative framework for the fiduciary standard was set in 1940 when the United States Congress passed the Investment Advisor Act of 1940. Now, the Investment Advisor Act of 1940 does not specifically spell out what a fiduciary can or cannot do. It really allowed that up to interpretation, but it created the legislative framework. Now, when you have a statute like this passed by a legislative body, then typically you will have regulatory agencies who will promulgate regulations to implement that. And there are a number of regulatory agencies involved when it comes to fiduciary, both the Securities and Exchange Commission and FINRA, for those of you who may hold FINRA licenses. So they're the two primary bodies you look, the regulatory bodies, but there's also the Department of Labor. The Department of Labor obviously has responsibility over ERISA standards. So you really have three federal agencies involved. But the legislative framework was set forth some 80 years ago by the Investment Advisor Act of 1940. Let me tell you, though, actually how it came about. That is, the fiduciary standard being decided. It really came about as a result of the Supreme Court of the United States rulings and irrespective of the 40 states, including the state of Minnesota, any rulings that state Supreme Court or lower courts in those respective states have made in terms of delineating what a fiduciary responsibility is. The most landmark recent ruling by SCOTUS on the fiduciary standard was actually in May of 2015. When you see this picture at the top left of the Supreme Court justices, you'll see that there are a number of justices in this picture who are no longer a part of the United States Supreme Court. Again, this is a snapshot from the 2015 session. In a unanimous decision, the United States Supreme Court vacated a lower ruling really requiring the imposition of a fiduciary standard on ERISA fiduciaries. Basically what they did, that is Supreme Court and unanimous 9-0 ruling, stated that these fiduciaries in Tibble versus Edison, Tibble was a plan participant, Edison as in Southern Edison, they had an obligation to do ongoing fiduciary monitoring. This was remarkable in that if you look at the next, if you look at the rulings of the court in that particular Supreme Court session, many of the rulings they made that year were 5-4, split decisions, but they came together as one body and made a unanimous decision that fiduciaries are required to do ongoing monitoring. Well, there's been a lot now written and said about the fiduciary rule, particularly since June of last year. That's June 5th of 2019, because the Department of the Securities and Exchange Commission promulgated a new standard. And that new standard is called Regulation Best Interest, or Reg BI. Now, at that time, again, June of last year, 2019, one of the commissioners, Robert Jackson, the Democratic appointed commission of the Securities and Exchange Commission, said this about the Reg BI, or Regulation Best Interest. It said it was not putting investors first, and that the commission, in effect, made a ruling not to hold investment advisors to a fiduciary standard. And when I say that, there was a regulation done prior to the decision by the SEC last June, again, June of 2019, and that draft regulation best interest proposed eliminating all material conflicts of interest related to financial incentives. However, the SEC decided to strip that out of the proposal. The Regulation BI does not impose any such duty to eliminate material conflicts of interest. And this is exactly, for those of you who haven't had the chance to read the 770 pages of evidence produced, I would draw your attention to this. And again, Dave and I will make copies of our slide decks available thereafter. Basically, what it says is there are key differences between Regulation Best Interest and the Advisors Act of 1940. The fiduciary standard really distinguishing between services and relationships offered under two different business models. For example, an investment advisor's fiduciary duty generally includes a duty to provide ongoing advice and monitoring, much like the Supreme Court ruled in May of 2015. While Regulation Best Interest imposes no such duty and instead requires that a broker-dealer act in the retail customer's best interest at the time a recommendation was made. This is a very, very substantial difference in terms of the not only the statutory framework, but judicial decisions that have been made relative to spelling out the responsibilities of a fiduciary. That is, this goes in conflict. Now, at the time, there was lots of press. Again, this is last summer, or the summer of 2019, where Regulation BI was seen as a gift to the wolves of Wall Street. And again, some advisors like the SEC's Reg BI, other ones, in their words here, hate it. But I come down on the side, and I'm speaking only for myself, not my firm. I come down to the side that I don't believe that SEC Regulation Best Interest really places retail investors' interest at its heart. Now, again, after these rulings were made last summer, again, the summer of 2019, not our most recent summer, there was lots of talk about and lots of press about the SEC's new investor protection rule might end the fiduciary debate. I don't believe that's the case. In fact, I know it's not the case in large part because the Certified Financial Planning Board set forth a new standard and standard of conduct and ethics code requiring certified financial planners to adhere to an expanded fiduciary standard. So again, I think that this decision is not yet in any way decided. Now, I will tell you, I mentioned that there are 3 federal regulatory bodies, and then there's state regulatory bodies as well, mostly at the Secretary of State's level, involved in trying to promulgate various fiduciary standards. Here you have the chairman of the SEC, Jay Clayton, on the left, and there you have Eugene Scalia, who is the Secretary of the Department of Labor on the right. They have been attempting to do what's called a harmonization. That harmonization would take DOL, the Department of Labor's fiduciary standard, and harmonize it with Regulation Best Interest. And again, I think at best, Regulation Best Interest is a watered down version and is not a true fiduciary standard. With that, what I'm going to do is hand the baton to my friend Dave, and he's going to talk about, he'll both share his background with you, and he's going to talk about the features and benefits of private placement life insurance and private placement VA. Dave, take it away.
Thank you, Rick. Great lead off there to the presentation. First off, just want to echo Rick's comments. Thank you to the CFA Society of Minnesota. It's a pleasure being able to share a few minutes with you today and hopefully share a relatively new idea or concept that you can potentially apply professionally in your practice. A brief background on myself. I work for a financial services platform based out of South Florida called Spearhead. We have a sort of a core wealth advisory where we consult with a small handful of ultra wealthy individuals and families. On a discretionary basis, we manage just north of $1 billion in total client assets. And the topic that we'll be discussing here today, private placement life insurance and private placement variable annuity, is a structure that we help to implement and consult with bigger balance sheet individuals and families and high net worth allocators that will utilize these structures to realize better after-tax outcomes across their balance sheets. And so my goal today is really to sort of walk through with Rick not only what PPLI is, but also how it's used and why this can be a very effective and valuable tool for you as the asset manager or the advisor to bring to your clients. Rick, you wanna flick to the next slide?
Sure.
All right, just to lead off, although I live in South Florida, my home's actually in Miami. I am a native of the upper Midwest. I grew up in Madison, Wisconsin. I'm a graduate of UW-Madison, and as some of you may guess, I'm a fan of the Wisconsin Badgers and the Green Bay Packers. Knowing that we are presenting to the Minnesota CFA Society, however, I do believe in playing nice in the sandbox. Hence, today I'm going to channel my inner Herb Brooks. Obviously, the man is a Minnesota and American hockey legend. In 1980, he famously led the U.S. hockey team to a defeat of the Soviets. And that team, I should note, was made up of both hockey players from the University of Wisconsin as well as the University of Minnesota, proving that Wisconsin and Minnesota, although we hate each other on the football field, we can indeed exist in pursuit of a higher goal. So today I'm going to be channeling my inner Herb Brooks. Herb Brooks also famously once said, "Great moments are born from great opportunity." We may not be battling the Soviets during today's presentation, but both Rick and I agree that there is a tremendous opportunity out there for the asset management and financial advisor communities to embrace solutions like PPLI and PPVA as a means to deliver greater after-tax outcomes and structural alpha to what you're doing for high net worth and family office clients. Next slide, Rick. All right, so leading off, just walking through what PPLI and PPVA are at a very high level. PPLI stands for Private Placement Life Insurance, PPVA, Private Placement Variable Annuities. Technically, these are considered variable insurance products. That being said, how they perform and how they're utilized with clients is very different from how an advisor would think about utilizing, let's say, a traditional or more retail-oriented life insurance or annuity product. Most notably, these are structures that clients will utilize as a means to make certain investments through those structures to realize better after-tax outcomes. More simply stated, clients will make certain investments through PPLI and PPVA because given the underlying tax attributes of those assets, it's more efficient, and the PPLI or PPVA chassis allows for a much more efficient compounding of those assets over the long term. These assets are wholesale, or excuse me, these structures are wholesale priced. They're offered via a small circle of insurance companies. In today's marketplace, the industry leaders include firms like Prudential, Lombard International, Zurich, Crown Global. These are several of the major carriers in this space. These contracts are priced on a wholesale basis, fully transparent to the client up front. And most importantly, they function as an open architecture investment product, which means when a client funds a PPLI or PPVA contract, they can select you, the advisor, or the asset manager to oversee your bespoke strategy through a life insurance or annuity chassis. Policy assets are invested through a segregated investment account. And as a result of that, under the Internal Revenue Code, those assets grow income tax deferred. And in the case of PPLI, if owned for the remainder of a client's life, potentially income tax eliminated upon the death of the policyholder. These are a very nifty and I'd say flexible solution that can allow you, the asset manager or advisor, to offer your clients a much more tax efficient, either tax deferred or tax eliminated asset location through which you can manage your bespoke strategies. Let's move to the next slide. A few other key features of these products. PPLI and PPVA are considered creditor protected in at least 26 states, as well as a number of offshore jurisdictions. They're also considered segregated from the assets and liabilities of the insurance company and not subject to the creditors of the insurance company in the event of a bankruptcy. Hence, these are structures that lend themselves to providing asset protection for clients over the long term and provide peace of mind to bigger balance sheet clients who are considering contributing assets to these type of structures. As I mentioned, this is really at its core an asset management tool. I know it qualifies as either life insurance or variable annuity under the Internal Revenue Code. However, these are structures that are utilized by clients and their advisors primarily as an asset management and a tax management tool, which we'll cover in a couple of slides. And then lastly, these are US law compliant structures. They're codified under Section 7702 of the Internal Revenue Code, as well as Section 817H. And this is a sort of a small niche within the life insurance and annuities marketplace that has existed since the mid-1990s. And popularity of these structures has really ebbed and flowed over time, depending on sort of the level of federal as well as state and local income tax rates. Generally speaking, when tax rates are higher, popularity of these structures amongst ultra wealthy clients will rise. When we are in particularly low income tax jurisdictions or periods in history, these products tend to fall more out of favor. So just something to keep in mind. Next slide, Rick. So who uses PPLI and PPVA? Really your addressable market is wealthy individuals, families, and institutional allocators with 20 to 30 million or more in investable assets. By definition, purchasers of these contracts have to qualify as both accredited investors as well as QPs. So this is not a product that you can bring to any client in particular. This is a solution that, due to some of the complexity associated with it, really only makes sense for clients who can potentially fund significant amounts of premium into these contracts. That being said, a few common applications where clients might consider funding PPLI or PPVA, probably first and foremost are just assets that a client has that are earmarked for long-term legacy planning or intergenerational wealth transfer or gifting to the next generation. By housing a certain subset of a client's investment assets through a PPLI structure, the advisor maintains the ability to manage a custom allocation for the client through the PPLI or PPVA contract. However, upon the client's death, those assets will pay out income tax-free to the client's beneficiaries. And hence for clients who have long-term assets that are earmarked to give to the next generation, oftentimes PPLI can function as a much more tax-efficient means to not only grow those assets during the client's lifetime, but also then transfer them upon death to the next generation. In addition, because PPLI and PPVA function as very tax-efficient asset locations on client balance sheets, they're also often used as a pre-migratory or retirement planning vehicle for clients who live in high income tax state jurisdictions today, but intend to eventually move or perhaps retire to lower income tax jurisdictions today. So let's say hypothetically a client's living in California, New York, Illinois, intends to move to Texas or Florida eventually. Well, during their wealth accumulation years, they may save a portion of their investment dollars through a PPLI or PPVA contract, knowing that when they're saving those dollars, they're saving them on a tax deferred basis. But when they eventually pull those assets out of the PPLI or PPVA contract, upon retirement, they can do so in a lower income tax jurisdiction. For advisors out there, we also see applications where clients own, let's say, existing retail-oriented traditional, retail annuity structures or life insurance structures with significant cash values, and oftentimes clients are, own products that are very inflexible. Perhaps they have limited investment options to the client, and significant fees associated with those structures. PPLI and PPVA can provide the client with an outlet where they can essentially 1035 exchange with the insurance company one existing life insurance or annuity contract for another. So exchange their existing contract for a PPLI or PPVA contract, and the client is enabled because not only is the PPLI or PPVA contract going to be lower in cost, lower in fees, have a significantly less overall cost drag associated with it, but it'll also allow the client's advisor or asset manager hand selected by the client to build a custom portfolio inside of the PPLI or PPVA chassis for the client. Other uses, I mentioned this earlier, the asset protection benefits. These structures do tend to be popular with clients in litigious industries. So if you're dealing with entrepreneurs or doctors or real estate developers who, may be subject to bankruptcy or, other litigation, these structures, as I mentioned, are considered asset protected in a number of jurisdictions, and as a result, are often utilized by, individuals that work in those industries. And then finally, U.S. pre-immigration planning. If you're working with, let's say, non-U.S. clients who are looking for a tax efficient and reporting efficient means to invest in the U.S., making investments through PPLI and PPVA by virtue of being life insurance and annuity structures can be particularly efficient for the client, and allow non-U.S. clients to make investments in the U.S. without establishing a U.S. tax footprint. Rick, you want to go to the next slide?
Yep.
So I think this is maybe this next three slides are maybe the three most impactful of the presentation. I think this should give a pretty clear picture of the arbitrage involved in structuring certain investments through a PPLI or PPVA contract. All right, hypothetically speaking, let's say you're working with a high net client living in California. They're investing in a bucket of assets that may be particularly tax inefficient. Perhaps they're taxed at some combination of ordinary income and long-term capital gains rates. Obviously, clients living in a high income tax jurisdiction like California, they may be subject to a 37% federal rate, 13.3% California state income tax, 3.8 Obamacare tax. So at the end of the day, a client can invest in a bucket of alternatives that produces an 8% return. That being said, after you account for costs at a federal and state level, that client's net investment return is only 4.01%. So tax can have a tremendously dilutive effect on clients' ability to compound their wealth over the long term. Let's go to the next slide. Now compare that with an investment made through PPLI. Now, PPLI, it's a life insurance structure, but it features a segregated investment account through which a client's advisor or asset manager can make certain investments. All right, as you can see, the client's investment will compound, free of federal income tax and state income tax on an annual basis inside of the policy account. The only cost to the client is a minimal cost associated with the life insurance structure, or in the case of PPVA, the variable annuity structure. It's a cost that gets deducted by the policy annually by the insurance carrier, and on a sort of long-term normalized basis, that cost averages out to about 80 basis points annually. So end result to the client is that their investment that otherwise would be growing at about 4% if they made it purely on a taxable basis. If they make that same investment via a PPLI structure, their net investment return is 7.2%. And next slide, please. So as you can see, there's a tremendous arbitrage involved in making certain investments for clients through the tax deferred or tax eliminated structure offered through PPLI or PPVA. And in essence, what the client's doing is trading taxes that they would otherwise pay for costs associated with an insurance contract. And in today's income tax environment, that arbitrage is particularly large. And I think, especially where we sit today, heading into, an uncertain election season, a post-COVID world, there's a lot of uncertainty about what's going to happen to taxation, especially as it relates to high income earning clients. Already New Jersey and California have introduced legislation to raise income tax rates on high income earning clients. And if those trends continue on both a state and a national level, the potential impact that PPLI and PPVA can provide to the client will only grow in value. Next slide, Rick. So this is just showing the pure numbers, comparing a similar investment made by a client through PPVA versus if they made that investment on a purely taxable basis. As you can see, over the long term, clients have the ability to compound their wealth much more efficiently through the variable annuity structure. By year 40, a $10 million investment, returning 8% annually would grow to $185 million, versus a similar taxable investment, which would grow to $48 million. The only difference is between those two amounts is structure and how a client owns their underlying investments. And that under $185 million, obviously the client's picking up a tremendous amount of additional compounding on their balance sheet just by eliminating the tax associated with the underlying investment assets. Why don't you skip ahead a couple slides, Rick?
Tell me when.
Skip through this one. And just real briefly, I'll touch on this. Sort of what's the flow of funds if a client decides they want to fund a PPLI or PPVA contract. There's sort of two main transactions involved. The first one is that the client will work with an experienced life insurance or annuities agent and fund a contract at either a US based or offshore insurance carrier. That premium payment that the client makes will then be deposited into a segregated investment account. And then the client will instruct the insurance carrier for their advisor or asset manager of their choosing to manage those policy assets on their behalf. And those assets can be managed through a couple of different structures called either insurance dedicated funds or separate managed accounts. Rick, you want to keep going?
To hear, Dave, this one or?
Yeah, this is good. Now, obviously, clients pick up a tremendous tax benefit by making certain investments through PPLI and PPVA. However, what do they give up as a result of doing that? Obviously, the government is extending a tremendous benefit by utilizing these structures, but what sacrifices does the client have to make, and what rules of the road do clients and advisors need to be aware of when they're making investments through PPLI and PPVA? There's really three main rules you have to cover. First is the segregated asset base. That means that when a client funds a PPLI or PPVA contract, those policy assets can only be invested in segregated account vehicles, either separate managed accounts or what are called insurance dedicated funds that are managed by a third-party advisor and have already been pre-approved as offerings on the insurance carrier platform. Secondly, there's a rule called diversification or 817H testing that applies to assets that are invested through PPLI and PPVA accounts. Most importantly, no one underlying asset or line item is permitted to represent more than 55% of the underlying policy account's assets. No two assets can represent more than 70% of the policy account, no 380, no 490. So there have to be at least 5 underlying assets or line items, whether they're equities in different businesses or 5 different bonds or ETFs or hedge funds that constitute that underlying portfolio. And then finally, there's a rule called the investor control doctrine, which simply states that the client does not have the discretion to select the specific underlying assets that are purchased within the PPLI or PPVA account. However, what the client can do is select the underlying investment advisor or asset manager to manage assets inside these accounts on their behalf. And when they do that, they essentially assign discretion of the asset investment management of those assets over to you, the advisor. We can keep going, Rick.
Let's transition then. Dave's handing off the baton to me. I'm going to put the, I guess, the compliance hat on for a moment as a fiduciary. I'm duly registered. I have both broker-dealer licenses, but I'm an investment advisor representative. I have, and like to fancy myself, I've always held myself to the fiduciary standard. So if you are a fiduciary, and again, I assume most of our listening audience, maybe all of our listening audience, do consider themselves fiduciaries and or hold themselves to those standards, that of course you have to disclose upfront commissions, if any. You have to disclose if there's any revenue sharing in these particular products. You have to disclose and should disclose if your asset manager has, let's say, a hedge fund or a private equity fund, and they have a performance incentive fee. Of course, you must disclose that. you have to exercise the duty of care. The duty of care is one of the fiduciary duties that's not spoken about a lot. What the duty of care really requires you to do as a fiduciary is to consider a range of alternative investment strategies that might accomplish similar objectives to what you're trying to do with that respective investor, but yet possibly at either lower risk or a lower cost. Another fiduciary disclosure, a very attractive feature of private placement variable annuities, as Dave just outlined, significant attractive feature or benefit is the tax deferral you get, but there's no surrender penalty with these. That means that it really facilitates 1035 exchanges. The other area of fiduciary advantages, before we transition to the last part that I'll speak about today, is the importance of, and again, I think Dave has already highlighted this, I'm going to reemphasize it in a moment, the importance of fiduciaries trying to find ways to reduce performance drag. That is by minimizing current federal and state income taxes, the net investment income tax, and estate taxes. The importance of a fiduciary aligning your interest so that to the extent possible, there's no upfront commissions, there's no surrender charge, no revenue sharing. We understand, again, Dave and I being in the business for the length of time that we both have been, that there are instances where advisors may in fact share in revenue. But all in all, transparency, disclosing those costs are critically important. We also believe to the extent that you can squeeze out certain costs. One of the advantages of private placement variable annuities versus the kind of retail annuities that we sold, my wholesaler team sold at Fortis Financial, is that it strips out costly, non-essential riders. Those riders may be nice to have, but not need to have, and all those riders have attendant cost associated. Another point that Dave made in this presentation is the range of investments you can have in private placement life insurance and a private placement variable annuity vehicle are almost unlimited. That is, you have an open architecture, so you have a much, much wider opportunity set of alternative investments. So when you're selling private placement life insurance, of course, you're going to have an illustration. If you're working with someone like Dave at Spirit Capital, or your underwriter, that is your insurer that's going to issue this policy, of course, you're going to have an illustration. And if you're selling private placement variable annuities, you may well run a hypothetical that shows hypothetical performance over 10, 20, 30, 40 years. The reason I'm using those time frames is because these investment vehicles tend to be held for decades, not for single numbered years, but for 10, 20, 30 years. I believe, though, at its heart, that you will be the most effective advisor and fiduciary to the extent that you can engage in some kind of conceptual storytelling. That is to really, really have a frame. So the frame, I'm going to use in my final moments with you. I came up with an analogy of looking at performance drag and using drag racing as my analogy, if you will, because I believe it's not what investors make, but what they keep that's most important. But there are many, many advisors that have a blind spot. That is, they'll talk about returns, but in the absence of looking at the real impact of current federal and state taxes. And for those individuals who are going to be policyholders of PPLI or PPVA, they are going to be at your highest marginal tax brackets. They are going to be subject to the net investment income tax levy that Dave spoke about earlier of the 3.8%. So really what you want to do is you want to find ways to minimize that tax drive, because the tax drag, not drive, tax drag is the most significant of all the drags on performance you have for investment vehicles, and that's true across the board. So we have here the 2020, both marginal tax rates for unmarried, married heads of households. I have a snapshot there of the 2020 capital gains tax rates. There's the 3.8% net investment income tax display. And then finally, again, you all in either Minnesota, knowing that the highest marginal rate in Minnesota when for 2020 was 9.85%. When you add it up, your clients may be paying greater than 50% of their annual return may be forfeited on a current basis to the federal and state tax authorities. The second consideration you have as a fiduciary is looking at location, location, location. There are hundreds of, there's certainly dozens, but maybe even hundreds of variety of kinds of investment vehicles. And when I say that, generic types of investment vehicles. When looking at asset location, you want to take those investments that clients have that generate higher turnover and put them in the most tax efficient wrapper. That wrapper happens to be an insurance or annuity wrapper. Why? It gives you the automatic tax deferral benefit. And again, as Dave spoke earlier, when you put it in a private placement life insurance policy and the distribution is made at time of death of the policyholder, then it's going to transfer to the estate or the heirs on an income tax-free basis as well. So when you look at alternative investments, and again, that's one of your duties of care as a fiduciary, to consider the landscape of alternative investments. Many of these alternative investments, be they emerging market funds, hedge funds, whatever, have an annual tax drag of 2.5% to 3.5%. That's because of the high turnover in those strategies, which takes you again even further north of 50%. That's why these type of alternative investment strategies, I think, and Dave, in my opinion, are best held in an investment vehicle like PPLI or PPVA. Reducing fees. You as a fiduciary should look for ways to eliminate or mitigate the friction on capital growth by finding institutionally priced products. You can find institutionally priced life insurance in the PPLI space. You can find institutionally priced variable annuities in the PPVA space. Again, having worked both as national sales manager at New England Annuities and at Fortis Financial, I can tell you through direct experience that the institutional price clients receive on these products are significantly lower than retail price life or variable annuity products. And I mentioned this already, when you look at the VA space, stripping out these non-essential costly riders like guaranteed minimum death benefits, guaranteed minimum income benefits, do people like to have those? Of course they do. Investors, if you ask them, they'd like everything possible, but they don't want to pay for those. I think it's much more advantageous to look at institutionally priced products like PPLI and PPVA. The final 2 points I'm going to talk about before I hand that baton back to Dave is what are the areas that people are most concerned with, and we had to revisit this issue in March of this year when we had the fastest downturn in the history of the S&P, losing some 33% over the course of a little bit more than one trading month. Well, many investors, not all, but many investors are interested in tail risk insurance. Here's the problem with tail risk insurance. It's a protection racket, and you have to pay a VIG to get that protection. And when you look at tail risk insurance products and tail risk protection strategies, they can be very expensive. This is a report that I had to read back when I was studying for my Chartered Alternative Investment Analyst exams. It looked at State Street Global categorized 7 different types of tail risk protection strategies. They found among the most expensive were going long the VIX. It's because of contango in the VIX marketplace. It's a wasting asset, or using variance swaps. If you look at the traditional means that institutional investors have purchased tail risk protection, what they've done is they bought puts. Puts can run you on a yearly basis, 268 bips. The one strategy that was most advantageous is the one on the lower left side, exposure management. Not only, if you pick the right tactical manager, not only do you not pay a negative tail risk drag, you can actually add to the value of a portfolio. It's something to think about when you're looking at the type of alternative investment strategy that you're going to select for a client in a private placement life insurance vehicle or a private placement variable annuity vehicle. You want to look for at least consider tactical managers that can get out of the way when we have the kind of downturns that we've had both in September, March, late February of 2020. So when you look at PPLI and PPVA, I believe it's the ultimate driving machine. It's the ideal vehicle. Why? You don't have the kinds of, let's say, IRS or congressionally mandated plan contribution limits or caps that you would have on 401ks or Roth IRAs or whatever. You have a wide opportunity set, as Dave talked about earlier, an open architecture that allows you to look at a variety of different alternative investment strategies. You have a customized policy with transparent fee disclosure. As Dave pointed out, 25 states allow asset protection, and in a separately managed account, as these investments are held, creditors to those insurance companies don't have claims against your client's assets. Guess what? No K-1 forms required as well. I believe what a PPLI and PPVA policy does is it puts the policyholder in the driver's seat and allows them to navigate the road to wealth. Rather than summarize now, let me turn the baton back to Dave, and we'll do some summary at the end along with answer your questions and answers. So Dave, handing the baton to you.
Thanks, Rick. You want to skip through these slides?
Sure, you tell me when to stop.
Yeah, I'll stop here. This is sort of getting to the why. Like, why is this, meaningful or important for an asset manager or an advisor who is working with, a high net worth individual? First and foremost, looking at the investment landscape, there's any number of investment advisors out there, investment strategies, investment managers, all pitching their products. From experience, 90% of advisors spend their time focused on what it is they want to invest in. What does that asset allocation look like? What strategies or portfolio construction is ideal for the client. However, where I think a lot of the asset management community falls short is in thinking about where do I properly locate this investment on a client's balance sheet to realize better after-tax returns. And that's really sort of the basis for PPLI and PPVA, is enabling the client and providing additional optionality to the client and the advisor in where certain investments are made in order to effectuate greater after-tax outcomes. If you look at sort of the typical, let's call it high net worth or family office allocator balance sheet, more often than not, 10 to 20% of a client's overall investment assets generate 80% of their income tax headache at the end of the day. Those may be investments in hedge funds, in private equity or private credit, perhaps strategies that generate significant ordinary income or short-term capital gains. Altering how the client owns that, let's call it 10 to 20% of their overall investment assets by housing them inside of a more efficient structure can enable a client to compound their balance sheet much more efficiently over the long term, producing additional wealth that they can eventually either pass on to their beneficiaries and loved ones or to their charity. So it's really these structures are about providing additional optionality to a client. Why is this important for you as the advisor? It's really a way for you to introduce a new and differentiated product to your client base that perhaps hasn't heard of these products before, or hasn't been pitched this by their existing advisor or a competing advisor. It's also for you as the asset manager, another means to provide entree into the high net worth and ultra high net worth marketplace. It gives you something unique that you can bring to high net worth clientele that, as mentioned, perhaps they haven't heard before. Another benefit of PPLI and PPVA is that these tend to be long-term structures that clients own on their balance sheets. Given the inherent tax benefits of the structures that Rick and I have walked through, these tend to represent sticky assets, meaning clients will oftentimes fund a PPLI or PPVA contract with the intention of owning that on their balance sheet for the remainder of their lives. And so it lends itself very well to maintaining a long-term relationship with the asset manager or fiduciary as well that's overseeing the allocation inside of that PPLI or PPVA account. Furthermore, for you as the asset manager, it gives you another outlet to generate recurring revenue for your firm and increase the valuation of your firm. And it also gives you an opportunity to hold yourself out as the center of influence to other partners in the marketplace, whether they be CPA firms, tax and estate planning attorneys, other family offices or high net worth individuals. You can put yourself out as a thought leader if you bring them unique solutions like this to solve their problems if they do experience issues as it relates to taxation of their investment assets. I think that's about what we had for today. I do see a question in the chat box that I can take a first stab at, and Rick, if you'd like to contribute as well. What is the minimum recommended investment account to purchase PPLI or PPVA? So I mentioned earlier, this is really a product that makes sense for a client who's worth 20 to 30 million or more in investable assets. Based on experience, most clients will fund somewhere between 10 and 20% of their overall investable assets into these contracts. That funding is done via cash to the insurance company. So for a $20 million individual, that would represent a $2 to $4 million policy. Now, most of the major insurance carriers in the space have a minimum policy or premium amount that they require to fund a new contract. Depending on the carrier, that dollar amount is typically between $2 and $4 million. So that is the minimum size. I'd say the average size contract in the industry is probably in the neighborhood of 10 million or more. Just given that these structures are utilized in particular by a lot of bigger balance sheets, individuals and families that have the means to contribute significant premium dollars to these contracts.
And without getting too much into the weeds, Alexander and Dave can give you this on case studies as well. For those individuals who are using private placement life insurance, there are certain death benefit corridors that must be satisfied for the Internal Revenue Service. What they don't want people are taking $100 million, putting it in as a 1-year premium contribution and getting a death benefit of $10 million. So in order to avoid a MEC, a modified endowment contract, many of these policies and the private placement life insurance will be structured to have multiple pay. You might pay over 4 years, you might pay over 7 years. That is to make sure that you're within the IRS quarters. But again, Dave can give you more color on that. And one of the things that I'd recommend that all of you do, to the extent that you want to engage in case studies, please feel free to reach out to Dave or myself and ask about how you might be able to use some of these strategies. But very good question that you had there.
Yeah, and I would just add one more thing. As Rick mentioned, these structures are flexible in how they can be funded. As Rick mentioned, oftentimes clients will fund these via a scheduled series of payments over multiple years. Other policy designs allow for a client to make a single upfront lump sum payment of their premium dollars. PPVA, the variable annuity option, offers arguably the most flexibility. The client can essentially fund that at any time and then top off or up their premium payments to the annuity structure at any time as well. So for clients who are exploring a longer term savings vehicle, PPVA can provide additional flexibility for clients who may have uncertainty as it relates to when they'll be making premium payments.
Other questions that people might have, maybe Mark, Diane, and or Megan, if you could open up the lines if there are any other questions. Dave and I, we are 5 minutes before the hour here. So if you have any other questions?
This is Dave. I'd just add one more thing. If you're sitting in the advisors or asset managers chair and you're wondering how can I be linked up with an insurance company in order to manage accounts for clients through PPLI and PPVA, what are the minimum amounts needed for me to get approved by the insurance carrier? From experience, that number will vary from insurance carrier to insurance carrier, but generally speaking, a carrier will require 10 million or more of new premium dollars that your clients will be looking to direct to your strategies through PPLI or PPVA. So that could come from a single client who gives you a $10 million mandate and works with the insurance company to fund and structure a $10 million PPVA or PPLI contract, or that could be a combination of 5 different clients that are all funding $2 million into a contract. But that essentially allows you, the advisor or asset manager, to build a business case with the insurance carrier, where the insurance carrier can then justify the underlying due diligence and niceties involved in the approval process of getting your asset management or advisory practice approved as a discretionary manager on their insurance carrier investment menu.
I think that's very helpful. Any other questions that folks have?
Yeah, this is Mark. For some reason, Zoom is not letting me unmute all of you at one time. So if you do have a question you want to ask out loud, pose it to either Rick or David or both, please unmute yourself and do that. And while you're figuring out where the unmute control is, Rick, would you remind everybody on how to get a hold of the continuing education credits for the CFP folks? I will tell you right now that in the evaluation information we send out post-event, we'll have information in there for you CFA charter holders, because we have access to some of that information, but we don't have any access to the CFP stuff. So Rick, remind them of how they can get those credits.
Sure, thank you, Mark. If you are a certified financial planner and would like to receive the 1 hour continuing credit that this program is accredited for, please send me at rroche, that's R-R-O-C-H-E, at littleharboradvisors.com. We spell our advisors O-R-S.com. Please send me your proper first name, of course, your full first name, last name, and your unique CFP ID number. If you send that to me, I'll make sure that I file it with the CFP board in Washington, D.C. As a heads up, Dave and I are making copies of this slide deck available, and Dave and my contact information are contained on slides in the deck. So for those of you who want to have a follow-up with us, please look at the slide deck that you get. We're also going to make available an article that was published on Friday in the Investments in Wealth Monitor. If there are any people that hold SEMA charters, you know what the Investments in Wealth Monitor is, a publication published 6 times per year by the Investments in Wealth Institute. There's an article on IDF. IDF is an insurance dedicated fund, how to beat performance drag. So we're going to include that as well for as a form of thanks, if you will, for those of you who have joined us today. Dave, do you have any closing thoughts for our audience, for our attendees?
I think we pretty much hit it. Thanks again to the CFA Society of Minnesota for inviting us to present today. And it's been a pleasure to be with you all.
And again, we would encourage any and all listening today, please do feel free to reach out either to Dave or to myself. Mark, we'll turn it over to you.
Thank you, and I apologize if you can hear the first Wednesday of the month testing of the early warning sirens in the background. Some things you just can't control. Anyway, yeah, thank you, Rick. Thank you, David. Really appreciate you taking the deep dive into private placement stuff today. Megan just shared in the chat that we will make sure that you guys have Rick's email in our follow-up to this event. So, and we'll also have a replay of this available as soon as we work out all the technology bugs and get that recording polished up and uploaded to our YouTube channel. So once again, thank you everybody so much, and stay home and stay safe, and we'll see you on the next webinar. Take care.
Sounds great. Have a great fall, everyone. Take care.
Yeah, you too.